Hello and welcome to another market update. Today is the 18th of August. It is Friday. Happy Friday, everyone. We're going back to video, although those of you who do consume our market updates on audio can still do that. We're going to produce two files now going forward that you can consume. I've had some feedback from some of you, which is awesome. Thank you. Keep the feedback coming. That you did like the video updates because I would show charts and graphs and some of the other live data that I would put up on the screen and walk through things. So I appreciate the feedback. I will actually now be doing both. So for those of you who want to continue consuming on audio because it's more convenient for you if you're on the train or in your car, what have you, keep doing that. I will do my best to describe things that I have on the screen and that I'm talking to so that you can get a sense of what I am showing people as I do the video work as well. And of course, you can always go back and review the video at 1.2 or 1.5 times speed, and I'll sound like a chipmunk, but you can get through it even a little bit faster. So with that being said, a lot of stuff going on in the markets. Top three things today are, number one, Japan. Going to talk about how Japan is absolutely ripping at the moment. Number two, inflation and interest rates. So I've combined those two things because they're talked about a lot in the same sentence these days, hand in glove, really, the relationship between the two. And then finally, I'm going to talk you through, it's a new concept that I'm learning about. It's not a new concept, but it's a new way of looking at some of the internal machinations of the market to understand what's going on, and that is volatility suppression and just looking at volatility funds and how they impact the market. So I'm going to just give you a little bit of insight into that. It is kind of wonky propeller head type stuff, but it is worth getting a little bit of an introduction to because it does impact on, it will impact and does impact on the shorter term what happens in markets. But first, let's talk about Japan. Japan put up an absolutely killer GDP number this past week, 6% GDP growth year on year, and they are in quad one. And you may have noticed I've been buying Japanese equities over the past few days because we've had a wonderful opportunity, a buying opportunity to add to Japanese equity positions. Japan is one of the bright sparks in the global economy right now in terms of the fact that they have come out of sort of quad four environment. They are in quad one. Their market, again, is killing it. Their exports are up. Their domestic market is robust. Everything about Japan right now is going well. There's some other Asian economies that are doing pretty well at the moment as well. I'm keeping an eye on South Korea. I do have a small position there, but it's something that South Korea is a little bit, it's not as close to what's going on in Japan because, again, Japan is absolutely ripping at the moment. But South Korea, Singapore, Indonesia, Philippines, these are all emerging market and other developed market economies in Southeast Asia that I'm watching. The one that is really getting hammered, though, on the flip side of Japan is China. China is getting smoked at the moment. They have some real serious problems, and I'll probably elaborate on that as we go through this market update. But I just wanted to highlight Japan because, again, they are in the sweet spot right now. It's one of the few places in the world where we can be long equity and aggressive with positioning, and I have done just that. So I would anticipate, we've seen kind of a bit of a market sell-off. Usually markets go down all in sympathy with each other. If we see a couple of bad days on the U.S. market, that tends to drag everyone else down. But Japan will hopefully decouple from that in the next couple of days, and we'll see those positions really start to add some alpha to our accounts. Now, number two, and this is really something that I've been watching closely. I've talked about it a lot, and I'm sure you're watching it closely too, and that's interest rates and inflation. So let's talk about inflation. First of all, inflation has been coming down. There's absolutely no doubt about that. Inflation has come down from those peak levels that we were seeing, and I'm actually just going to put a chart up of the U.S. and talk to it because Hedgeye does produce some fantastic material, and if I can just find the USA here, which I'm struggling to find. It's there, but is it? Ah, there we go. Got it. Okay. So this chart, this is actually the GIP growth inflation policy charting that I get from Hedgeye. But on the right-hand side here, if I can get this thing to scroll over, there we go. It's been a little while since I've done this, guys, so I'm a little rusty on the tools. Nevertheless, this is our inflation chart here on the right, and it shows, as you can see, inflation ramping out of 2021 from super low levels, 1.2, 1.3%, 1.9, then just ratcheting up in the U.S. to a peak of about 8.63%, and then now coming down on the other side of that to sit around the 4% mark. Now, inflation's going to kind of level off over the coming quarters around the 3.5% range in the U.S., which, of course, I remind you, is not the 2 to 3% target range that the central banks broadly have. So the Fed came out, I think, a couple of days ago, I think maybe it was the minutes of a Fed meeting were released, and they basically said, hey, the inflation battle isn't over, and there is a risk of an increase or a spike in inflation. And I'm going to talk about where that might come from in a second. But the point is that for those of you who think, or if you're listening to any bullshit out there from market commentators about how, inflation has peaked, inflation has peaked, how inflation is now under control, I suppose is a better way to put it, and interest rates have peaked, I would invite you to just be cautious with those opinions. That's not what the market is telling us at the moment, because bond yields have been rising, by the way, over the past couple of weeks, and inflation numbers, they're a bit finicky. So we're going to see some things that are going to impact inflation, particularly in Australia. And actually, let me just throw a chart of Australian inflation up here for you. Just quickly to lock off what I'm looking at here, the U.S. inflation data is now going to level off, and there is a risk of an upside surprise there. And it's really going to be off the back of the oil price. And I don't want Austria, I want Australia. So I'm just flipping over to a chart of Australia now, and our inflation rate is also kind of going to level off over the coming quarters. It's sitting around that 4.5% sort of annualized at the moment. And one of the things for those of you who have seen these charts before, you might notice is that the current forecast is for Australia to be in a quad 1 environment. Now, one of the reasons I'm discounting that is because there's still a probability that we'll be in quad 4. It's kind of like a 50-50 quad 1 or quad 4 scenario, with also the possibility maybe of a visit to quad 3. But it's more likely going to be a quad 1 or quad 4 because of what's going to be happening with GDP and I dare say also inflation. But nonetheless, the Australian inflation CPI headline numbers level off around that 4% range, which again, I remind you, is not 2 to 3%, which is what the RBA's target range is. Now, it's been coming down and coming down fairly quickly, which is fantastic. That's exactly what the RBA wanted to have happen. That's why they put rates up. I was at an event on Wednesday. It was a mortgage industry event, and there were people there who were just, my God, I don't understand, and I'm going to go on a bit of a rant here, but I just don't understand how people don't get that we are actually at interest rate settings that are pretty normal long term. I've talked about this before, and for those of you who are new to these market updates, if you just do a little bit of research, and it's not hard to find, you can get a long-term chart of Australian interest rates. The interest rates that we have right now are the exact same interest rates that I was writing when I was writing loans, and I still write loans, by the way, but when I was writing loans when I first started in the industry back in 2002 and 2003. Same interest rates. And yet you would think that the world is about to end because we have these interest rates. What I actually think is going on is that, and this is a comment on society in general, but what I think is going on is that people have become too accustomed to getting everything right now. And that is off the back of a lot of cheap money that's flown into the economy. And people have been conditioned. Economic behavior has been conditioned that you can buy now, pay later. You can put things on credit cards. You can get a pretty low interest rate mortgage and not worry about the future. All of this kind of stuff. And I'd love to hear your comments on this because I'm 52. I've lived through, even though I was a young lad, but I've lived through those 17% interest rates. I didn't have a mortgage, at the age of 10. Don't worry about that. But I remember my parents talking about it. And of course, as a student of economic history and someone who really does love this stuff and studies it to see how the past might be a predictor of the future. Um, I promise you that if you talk to your parents, any of you in my client base, most of you are um, of similar age to me. So your parents would be probably of the baby boomer generation. Now, some of you are a bit older, and thank you for being my clients. And your parents, in particular, the Great Depression era people would probably be, if they're still alive, that's fantastic. But if they are not, they'd be rolling in their grave listening to this bullshit uh, pablum coming out of I probably late Gen Xers, but really Gen Yers, moaning about the cost of living and so forth. I mean, please, let's go back to uh, wartime when everything was rationed, or coming out of these great economic calamities like the GFC and even for that matter, COVID, which certainly would be playing on the minds of a lot of people at the moment. And just think about actually how good we have it in terms of relatively easy to obtain credit and interest rates that are relatively low by historical standards, and just stop the moaning. My God. Anyway, the thing that really triggered me, as you can tell, I'm triggered at the moment, is that I had there was a lady who is a very well-known industry person, and whom I respect, but put up a couple of videos of people who were just, it was just all emotive, and it was like, oh, I'm in a poor state of mind because I'm uncertain about the future of my mortgage repayments and stuff like that. And I'm like, okay, well, I get that, and I get that there will be people out there who might be under some financial stress because of what's going on. But my question is, what choices have those people made around their personal finances that might have put them in that predicament? You cannot tell from a 2-minute video someone being real emotive about their finances what's actually going on under the hood. Anyway, rant over. Let's get back to the point, which is that we have a still a mortgage cliff that we're facing, which is to say that the mortgage resets, so the people that were on those great, fantastic 2 and 3 year fixed rates that we had during COVID, they're all starting to roll off. That's starting to impact the economy, and we have a situation in Australia in particular where inflation may actually reaccelerate. So you remember back in April, we got the April inflation numbers. I think it was May that we got it was May that we got the April inflation numbers, and I think this is the right time frame. It was either May in June when we got a rate rise that no one was predicting because inflation ticked up. You remember that one? Right? So that could happen again, and here's what's going to trigger it. The Aussie dollar, and I've talked about this before as well. The Aussie dollar is a direct function of how much inflation we have in our country, and I'm going to tell you exactly how that works. As the Aussie dollar falls, everything that we import gets more expensive. What's one of the biggest imports to Australia? Energy, oil, gasoline. These are things that impact everybody everywhere, and that is because even if you don't have a car, you live in the city and you walk everywhere, take the train, doesn't matter. Your food has to be transported. The clothing that you purchase at wherever you purchase your clothing from has to be transported. So the oil price affects everything, not least of which for those of you who travel a lot for work or just have a car and just get around on weekends and whatnot, it's going to impact your disposable income. So the point is that I don't want to move on to vol suppression, but the point about all of this is that inflation in Australia, we are at risk of inflation in Australia and the U.S. for that matter, ticking up again. That's going to pretty much seal the deal for rates staying probably where they are or possibly going up. We'll see. I actually think that rates in Australia may have leveled off. I think there's been a lot of combined and concerted effort by the media, by politicians, et cetera, to apply pressure to the RBA to keep rates on hold. I think that's probably what they're going to do now, but I reserve the right to change that opinion if we see inflation data going up. And I promise you, if inflation starts to tick up again, these central bankers are going to turn white, again, as in like white knuckle ride, like on the roller coaster, and go, holy shit, and probably raise interest rates again, just to make sure that we don't go back into an inflation reaccelerating. So that all that being said, we're still in a pretty particularly I had a word I was going to use, and it just went in and out of my brain. But we're in a particularly precarious, there you go, precarious situation in markets, because if we start to see inflation reaccelerating, bond prices are going to spike again. Interest rates are going to spike again in the bond market, and we're going to see a further pain. So let's talk about vol suppression. Vol is volatility. And one of the things, and I'll just see if I can get it up on the screen here real quick for you, the VIX, which is a measure that I talk about and have talked about a lot, is, now why won't this chart, oh, here we go. It's a measure of what is going on in markets, and the VIX has been relatively light on in the last probably, let's say, 2 months. So the month of June and July, vol was actually in the investable bucket. So for those of you who've been longtime watchers and listeners of these market updates, you know that there's 3 buckets of volatility. We have the investable bucket, which is vol, as in the VIX, between 9 and about 15, 16. The chop bucket is sort of 17, 18 up to about 22, 23. And the F bucket, which is you can fill in F as you see fit, but the F bucket is when you get to vol sort of 20, high 20s into the 30s. That's when you just don't go near equities. Now, volatility, the thing that I'm learning about volatility, and I did not know this, is there's actually funds out there that trade volatility exclusively, and there are insurance companies and other people that manage money long term that use vol funds and buy and sell options and futures and all this sort of stuff in the volatility market to hedge their portfolios. It's kind of like a hedging situation. A lot of the dealers that provide pretty much most of the volume on the markets these days, about 90% of volume that goes through markets is from high frequency trading and so forth. These guys provide a lot of the hedging strategies and do all these hedging strategies and things in the background. So the point is that it influences volatility, and we've been in an environment in the last 2 months, 3 months, where volatility has been suppressed. And that's just a function of how these market participants behave in the markets. And again, I'm still learning about this. So there's this whole thing about, it's called dealer gamma, and it has to do with where we are in relation to, so where the market, for example, the S&P 500 is one of the major indexes that's tracked, where the S&P 500 is trading in relation to where a lot of these dealers are positioned. And what they'll do is they'll buy or sell equities and buy or sell options and volatility to keep their books sort of trying to, I guess, keep them neutral to the market and these sorts of things. So it's a hedging strategy. That's about as deep as I can go on that subject right now without having my head explode. It's quite a complicated subject, and one that I'm going to continue to study and understand, because it's going to impact the market in the short term, and it's one of those things like putting a balloon or a beach ball underwater that eventually something can break. And if it breaks, it can break either way, by the way, upside or downside. But these things tend to really accelerate to the downside if they break, because what happens is things start to feed quickly on themselves, and you get a self-fulfilling prophecy when you start getting big sell-offs in markets. So I guess that's all I'll really say about vol suppression. But some of you may have noticed, I just want to call it out, some of you may have noticed that volatility has been in the investable bucket, and yet most of the indices are down now for this year, and they're certainly down since the November full cycle peak, which is where the S&P, NASDAQ, Russell all peaked. So you might be asking the question of yourselves, well, how can that be when volatility has been so low? Well, it's a function of, and I've talked about this before, just as a quick refresher and reminder, it's a function of, and I'm just going to get this chart back off the screen here, but it is a function of corporate earnings and a lot of other things that go on out there in the economy to impact mainly stock prices are impacted by earnings. If corporations are not earning the cash flow and the cash flow is flowing to the bottom line in terms of net profits and then dividend payments and so forth, then you're not going to pay multiples of stock prices in order to buy those future cash flow streams. That's just basic business principles. So the stock markets continue to price in that earnings are going to continue to fall. Part of that function is related to interest rates because the cost of capital has gone up. I've talked about the cost of capital before, just to refresh and to introduce this subject to any of our new clients. The cost of capital drives a lot of profitability for business. And it's one of the reasons why business confidence has eroded over the last couple of years, because businesses quite clearly see that the cost for them to borrow money, to fund their operations and so forth has gone up, and it impacts margins. They can't pass on necessarily all of that margin compression or increase in costs to consumers, because the consumer can only absorb so much at any given time because of all the other pressures out there. So, we're still in, I think the best way to just sum this up is that we're still in a very tricky environment economically. We are not out of the woods by any stretch of the imagination. We are still yet to really see, the recessionary environments that I think we're going to have developing, or they've already developed, but they'll be manifesting towards the back half of this year. China, I mentioned a moment ago, and I'll just quickly hit on them. They're in big trouble, both demographically as well as economically. China is a huge exporter, and their exports are down massively. There's something going on in China that's is very bad. They just cut their the PBOC, the People's Bank of China, cut one of their key interest rates, I think by 15 basis points, either yesterday or the day before. So they're trying to stimulate their economy. And there's also some talk of a couple of their real estate. Chinese real estate's a shit show. Like, I mean, they literally have built cities that no one lives in. All of this to sort of juice their GDP. And now all these chickens are going to start coming home to roost. Anyway, that's an issue. So China, being one of the largest economies in the world, when they sneeze, they used to say that when the U.S. sneezes, Australia catches a cold. Well, you know what? China's sneezing, and we're catching a cold because of that as well, due to the fact that we export a lot of raw material to China, and they're just not buying it. So let's just hit on a couple of other quick things. Oil price, I wanted to mention this. Oil has been going up over the course of the last couple of months, and this is flowing into, again, energy prices at the pump. That impacts people's disposable income. I've talked about that, you know that. And I suppose the last thing I'll just hit on is bond or interest rates. So banks have been adjusting their interest rates up and down. They seem to be now doing a lot of adjustments. Every week we seem to get some notification from a bank who is adjusting both their fixed rates and their variable rates. But I just wanted to point out, my current notebook started on the 18th of May, and the 15-year Aussie government bond was trading around, this is the interest rate, was 3.83%. Today, the 15-year rate, I just wrote it down this morning, the 15-year Australian government bond rate is 4.51%. That's a massive jump in, what is that, basically, it's actually 3 months, almost to the day. And the 2-year rate's been a little bit better, but the 2-year was around 3.5%. It's now almost 4%, 3.95%. The 10-year was 3.59, and the 10-year today is 4.26. Point is this, rates have gone up. Okay, pure and simple, rates have gone up. All the stuff I've just babbled on about, you should now know that as rates rise, the flow-on effect impacts the economy. These things take a lot of time to work themselves through the economy and through our just generally through people's pocketbooks and everything else. So again, I'm going to close this off because this has been a slightly longer market update, and I appreciate your patience with that. There was a lot to talk about today, so to lock it all off, this is what I'm focused on right now. Positioning and taking advantage of places in the globe where we can make some money, and looking to get fixed income or good fixed income return from some portion of our portfolio while we ride out this storm. We are in a storm. It will finish, and we will return to the quad 1 and quad 2 environments where we really make a lot of money at some point. I don't think that's going to be happening until probably mid next year. Again, we'll see. It's going to be data dependent. But in the meantime, what I would ask you to do as investors is, when you're in the shit, it seems like it's the worst thing that could possibly be happening to you. And it's from a psychological point of view, it can be, it can be distressing and all of that. But I would invite you to pull back and just look at your life as a whole and go, you know what? Most of you that I advise still have a good, 15 or 20 years left of living. Many of you have 30 and 40 and even 50 years left to go, right? So that's a long-term investment horizon. What happens over the course of the next year is going to be inconsequential to where we will be in 5 and 10 years' time. So put all of this in perspective. It sucks at the moment, and I'm not happy about some of the things that are going on out there. But as investors, we just have to figure out a way to invest through that and make good decisions and good choices. So with that, I'll say have a fantastic weekend, everyone. I hope you have some great plans for this weekend, and I will come back with more market update stuff next week. Have a good one. Take care. Bye-bye.